Okay, Hartford, the big Connecticut insurer. They're all big Connecticut insurers, right? Bows to a big shareholder. Eric Holm is here with the details on this one. I'm sure the company would not like me to describe it as bowing to a big shareholder, but it kind of sounds like they bowed to a big shareholder.
They're kind of bowing to a big shareholder.
It really does seem like that's a little bit of what's going on here.
Explain to us, give us the details on it. Explain to us what happened.
So John Paulson in February went on Hartford's fourth quarter conference call and urged them to do something drastic to turn around the share price, which trades at a very low multiple
below
to its book value.
Like
half its book value.
Half book value.
Yeah.
Half.
Yeah.
Book value,
which is less than most life insurers, less than most property casualty insurers, and Hartford is both. So Paulson has proposed splitting off the property casualty company. They're not doing that though. They instead are going to try to sell their life insurance arm, and they're shutting down their variable annuity book. So it's accomplishing much of what Paulson wanted to do, but sort of in a different way. Yeah.
And it's significant because, as your story makes clear, Hartford they basically started that variable annuity business, right?
Yeah, exactly. 10 years or so ago, they were it was one of the pioneers in sort of getting this going, and they were very innovative in it. It sort of backfired on them more than on other insurers in 2008, 2009 during the financial crisis, and they spent a little while digging out from that, and they actually had to be one of the few insurers that took TARP money, which they have since repaid.
We're looking at the stock price at $22 a share, and I have to tell you, Eric, one of the longest stories I've ever read in the journal. This is complicated stuff. Yeah. What's the takeaway? Is Hartford headed for extinction? I mean, is there what's the end game?
Well, they're going to end up as a company that it is built around their property casualty company, which is it sells to both consumers and it sells to mostly mid-sized businesses. So they're also going to keep a group benefits business, a life insurance business, but they're getting rid of that individual life insurance business, shutting down the variable annuities, which have both been sort of drains on their capital as opposed to businesses that create capital. They're looking to create a company that has a 12 to 30% ROE.
Is there a buyer for the variable annuity business?
Is there a buyer? No, they're just putting it in runoff. They're going to stop selling it. They'll keep servicing the existing policies, but not sell any more customers after a month from now. So go snap that up.
You saw the stock up 4% on a flat day for the market.
Sure.
That's decent, but that's not great. Is that going to be enough? Are the moves that they've made enough to satiate John Paulson?
We're still waiting to hear from Paulson on that stock move. It's still right around half book value. At some points it was below 40% of book value. It's very low.
Which is still stunning. I mean, I have to say, when you read this life insurer, this enormous financial company, is trading at half its book value.
There might be further stock rise or further stock reaction over the months as this plays out. They're giving us a 12 to 18 month timeline to institute everything they say they're going to do.
All right.